Hello, everyone, and welcome to our Move Smartly Market Update for October. For those of you who have been in our monthly webinars before, we're trying something new this month, streaming it on YouTube Live. Our sponsor this month is not Bell because we've been having Wi-Fi issues. So hopefully it's stable for today's discussion. But we've been having a few issues in the past and are trying to get it resolved. But hopefully we're going to be good for today. I'm going to walk through some of the latest trends that I'm seeing. Our editor at Move Smartly, Urmi Desai, is on the discussion as well today. She'll be keeping an eye on sort of the questions in the chat. Feel free to post them. But we're going to go right into today's topics. We're going to go over sort of the market update for houses. I'm going to chat a little bit about what's going on in the condo market, some of the on-the-ground trends that we're going to keep an eye on and we're looking at. Then I'm going to walk through some of these bigger trends, what I'm calling the good, bad, and the ugly for Toronto's housing market. So anyone who has any more specific questions about buying, selling, you can always connect with me. Just go to movesmartly.com/meetjohn, and you can kind of set up a consultation as well. And again, anyone who has to jump out early, we're going to have this live on YouTube after. And we're going to publish on our podcast as well, which you haven't checked out, check out as well, because we'll be doing more content on that as well. So just a little bit update on sort of the trends in the market right now. So when we look at the number of low-rise home sales, so that's, houses, semi-detached, detached, and row houses. Sales are unbelievably low in September. Again, we're basically at a 20-year low in sales. They were down from 42% from last month, but I mean, that's not the relevant stat. The relevant stat is sales are a very low level. And when we look at the number of new listings, that as well was actually down from last year, 16%. But again, the more important trend when we look at new listings data, I'm going to touch on it a little bit further, is that the number of new listings for houses was also at a 20-year low, which is telling us that sellers aren't moving, investors aren't necessarily listing, things are very sluggish. So part of the story of the low sales volume is, of course, the fact that there are fewer homes available to be bought. I mean, we're seeing that from our own clients who want to buy a home, and there's not a lot to look at right now. And the one or two homes that come up every week that are really nice, at least in the city of Toronto and the core where a lot of our businesses get a lot of interest, get multiple offers, get bully offers if you believe it, and then sort of the other homes are sitting on the market a little bit longer. So it's a very odd market right now, and one of the key issues is the fact that there's not a ton of inventory. So when we look at active listings is up over last year. But last year was unbelievably low, largely because sales were so high. But there's still very, very tight inventory. When we look at what we call the months of inventory, which is basically we just look at the number of homes that are available for sale at the end of the month. So say there's 100 homes, and we divide that by the number of homes that actually sold. So if there's 100 homes available and 50 homes sold, that would be 2 months of inventory. If 10 homes sold, that'd be 10 months of inventory. So low-rise market is just over 2 months of inventory, which is still a relatively competitive market. I mean, we've increased a lot since January, but January is really, under supply, which is why prices were rising 30+%. We're seeing fewer bidding wars, fewer homes selling for over the list price, but prices have stabilized since July for low-rise homes. And we're down still quite a bit from the peak. I mean, 23% or so from the peak. So prices in September were just over 1.3 million, and that's down from nearly 1.7 at the peak in February. Now, when we look at the condominium market, the trends are quite similar. Again, sales are down 49%, so really low volume of sales for condominiums. New listings, on the other, are also down compared to last year, and active listings are also up. Again, I mean, we're comparing to last year, which is very competitive market. So we're again, very similar trends. The months of inventory, however, for the condominium market, we have about 3 months of inventory, so a little bit more supply in the market. And again, we're seeing relatively few condominiums, far fewer actually condominiums sell for over the asking price. And again, this is a tactic that only works in competitive markets. So, and I kind of, I didn't talk about it earlier, but when I looked at some statistics for the low-rise market, you know, the homes in the central Toronto and the downtown core were more likely to get multiple offers and sell for over asking than the suburban market. And again, I think we're just seeing a little bit more demand there, some stability. So it's all regional, but again, in the condo market, we're seeing very few homes sell for over the asking price. And when we're looking at the condominium prices, prices for September around 750,000, they were, you know, they're down around 11% from the peak, but we're still up over last year when we look at condo prices. So that's just a kind of a quick high level look at what's going on when we look at the statistics, but some of the more, you know, on the ground trends that we're keeping an eye on. I mean, the first, like I said earlier, is that new listings are at basically a 20-year low in September. And this has really impacted sort of the dynamics we're seeing on the ground. If you look at, and this is a weekly chart of what we call the months of inventory. And what you'll see here is that in February, sort of the peak of the market, we had very, very few homes available for sale, like under 1 month of inventory. And this is accelerated right up to July for houses and for condominiums. But since then has actually declined, right? And has actually stabilized pretty much since August. And, you know, this is an interesting dynamic because, you know, changes in because the month of inventory is effectively sort of the demand and the supply in one metric, right? So as it increases, it's usually a sign that the market's cooling. As it decreases, like we saw in February, which is under 1 month, that's the sign the market's heating up and cooling. And when it starts to flatline, it's usually a sign of some stability in the market. And that's kind of what we're seeing right now. And I think the one important trend when we look at sort of the dynamics this has on prices, if you sort of keep in mind that inventory was rising from February to August, I mean, this is the chart of average prices for low-rise homes from February to now. And we can see sort of that stretch from February to August or July, we saw a rapid decline in prices. Prices have stabilized since then. Now, one thing I think is worth kind of chatting about is this idea of when we look at changes in house prices, are we talking about changes on a year-over-year basis or a month-over-month basis? And this is actually very important because when I was reporting on the dynamics in the housing market in the spring, a lot of real estate agents who like kind of giving a positive spin to statistics kept arguing that prices are up, you know, and I was basically saying, well, what's going on a year-over-year basis is irrelevant because if I go back, you can see that, you know, by May, home prices were plummeting, right? And I mean, just for some context, normally in normal housing markets, we look at changes in house prices on a year-over-year basis. That is normally what we do. And we do that because, you know, there could be slight differences in terms of seasonality from May and June and July and August in terms of the types of homes that sell. So we don't want to focus too much on what's going on a month-to-month basis. But when housing markets are very volatile, like they are this year, you know, the year-over-year becomes less relevant. What's we're more concerned about are the real-time changes in prices. So in the spring, I was focusing on the fact that prices were trending down month over month. A lot of very optimistic agents said that's misleading, but they're up year-over-year. Everything is great. But right now we have the opposite that's actually happening. And I'm going to layer onto that chart in red 2021 prices. So we can kind of see here that for most of the spring, even though this year in 2022 prices were trending down, they were up year-over-year. Now, as we're moving into the fall market, fall of 2021 is really when prices started to accelerate. For a good 9 months, they were actually flat. It was a very odd market in 2021. Prices had stabilized, things were normal. And then towards the end of the year is when the market exploded again. So right now, a lot of the news headlines are going to be talking about prices trending down year-over-year. But much like the spring, you know, my message to viewers is that's become less relevant now because these declines happened 4 months ago or 3 months ago. What the relevant statistics now are what's happening, which is on a month-over-month basis, which is pretty stable. But we're going to have to keep an eye to see, obviously, if that continues in the months ahead. But right up until February, even if prices stay flat, in February, the news will be that prices are down 20+% year over year, because that was the peak. So keep an eye on some of these statistics, because I think it's important. And then finally, just looking at, when we think about condominium prices are still up year over year. They've trended down from the peak. But we're still relatively, we're still a little bit up year over year. So the condo market is performing a little bit better than the low rise market. Condos prices didn't explode as much as low rise prices did. So before I jump into the next section, Remy, I thought I'd hit pause and see if we have any questions that.
Yes, we have thanks, John. We have a great question from Zaid. I think it might fit in better with your good, bad, and ugly discussion. So we'll hold that for there. I do have a question about some of the stats you shared. So you mentioned we're now seeing a plateauing of prices for both houses and condos. So the average prices are down how much from the peak in February?
Yeah, about 20-ish% from the peak in February for low rise.
For low rise. And condos are down a little less?
I think, yeah, they're down a little bit less. They're not quite as steep.
And one question is, what does this feel like on the ground? So if you're an active buyer or seller right now in Toronto, how are you experiencing this? Like, what is actually happening? You've got plateauing prices. Are you finding a lot of houses and you're still buying, or is everyone sitting on the sidelines?
So, I mean, there's a couple of things that are going on. So let's just approach it first from the buyer's perspective, right? We have a bunch of clients who are looking at buying homes. And the challenge is, there's a couple of things going on. Number one, there aren't a lot of homes to pick from, right? There aren't a lot of homes hitting the market. So like I said, the one or two great ones that hit the market, everyone, and are priced properly, everyone jumps on, right? So one of the challenges, even though there's not a lot of inventory, some homes are overpriced. The ones that are priced well, people are going towards the nicest one. And what's happening from what we're seeing from buyers is even the homes that are well priced and are good, people aren't rushing to jump on those. If it has some quirk that they don't like buyers are more patient, and I had, a couple of clients who said this to me on the weekend, if this was 6 months ago, we would have jumped all over this house, but we're not in a rush now. So we might wait for something a little bit nicer to come up or hit more of our check boxes, right? So that's what we're seeing from buyer's perspective, that there's just not a lot of inventory. Again, from sellers, very similar dynamics. I think for some sellers, they're having trouble adjusting to today's prices. So certainly some of the homes that we see in the suburbs and even in the city of Toronto are just overpriced, and they're not moving because the sellers expecting too much, and those homes sit on the market for a while. And what you end up seeing over time is those prices get adjusted down if the seller indeed needs to sell, right? And I've talked about this in last month's discussion, where what we're seeing is, in some cases, sellers are just taking their homes off the market or renting them or being patient. But again, that only works if you don't need to sell your home, right? If you need to sell for whatever reasons, those sellers are adjusting to the market gradually. But again, the interesting dynamic is we don't see a ton of inventory. You know what I mean? Like, even with those sellers who are a little bit stubborn and sticky on their price, usually that leads to a buildup of homes for sale, but we haven't seen that yet. So it's an odd dynamic for sure. Like, I didn't anticipate what's happening today. I mean, it's hard to anticipate some of these dynamics, but it's surprising that there's so little inventory and that prices have stabilized right now.
I think that touches nicely on another question from Zaid. Who historically has won in these situations where buyers and sellers are waiting each other out? Who has the greater resolve? It sounds like you're mentioning sellers normally tend to blink because if they have to sell, but is there something different to keep 100%. In mind?
Generally that's what happened. Like, in these types of environments, it's usually the sellers blink, right? Because you don't need every seller to fire sale their home, right? Like, all you need is one or two in a particular area, and they start resetting the prices, right? So it's usually the sellers who are, eager, motivated, need to move on, that start adjusting. But what's happening right now, to be frank, again, is that, the sellers who are blinking and adjusting are inflated to begin with, right? Like the moment they bring their homes down to today's prices, they're selling, right? Which is different from what happened in the spring. In the spring, buyers were patient and sellers were far more desperate because they had, in most cases, bought another home. So they couldn't just wait around for months. They had to sell in a week. So the decline in prices were more rapid. But what's happening today is a lot of the people who are selling haven't bought yet or aren't as desperate, so they can wait a little bit longer. But once they hit today's their market price, they're selling. But again, that's gonna, that's not to say we can't see a further decline in prices. If we see more listings at the market or more buyers pull out, yeah, you could see more pressure on prices.
I think Kevin is jumping in with a question many of us are wondering. And I'm wondering if you could tell us what the buyers you're working with are saying. Kevin asks, I think buyers jumping in now aren't considering that interest rates are still rising and are going to stay high through 2023 minimum. So what are the buyers that you're hearing from thinking? What's their thought process if they are still active?
Yeah, no, it's a great question. I mean, so we have I'll say our buyers fall into kind of one or two categories, right? The first category are the ones that need a home, like they're relocating, they have a life change, they have some life event, and they just need to buy a house. The other buyers are not as urgent. They want to buy a home. They'd like to move out of their rental or whatever it is if they're first-time buyers. But I'll say that in both cases, I don't think the buyers are expecting prices to explode over the next year. You know what I mean? They're not expecting that to happen. I think most of them do appreciate that prices may fall a little bit further as we move into the new year. But again, like if you think about what they're experiencing right now, it takes time to buy a home. Like it could take them 2, 3, 4 months. So even if prices fall a little bit further, their mindset is the right home going to hit the market? And at the end of the day, I think many of them are just thinking, I'm buying for 5 plus 10 years. I'm thinking about where the market's going to be the long term. I can't time the bottom, so to speak. So I think most buyers are just, I think they're optimistic about where the market will be 5 plus years from now. They're not worried about timing it precisely because, again, even if you knew the bottom, like it could take 5 months for you to find the home that fits your needs, right? So I think that's the challenge, and I think that's what we're seeing and hearing from buyers.
Great. I see another question about pre-con, but I know you're going to be touching on that as part of your good, bad, and ugly.
So for sure. Okay, so I'll jump in on this section. So, I mean, this section really came about because the past month or so, I spent some time talking with government organizations like the IMF and Bank of America and a few other organizations. Obviously, they're looking at and trying to understand the dynamics in Toronto's housing market. And of course, they're looking at things more from a systemic risk perspective and financial stability perspective, not a housing affordability perspective. So, and I say that because, some of the things that I talk about in terms of the good for Toronto's housing market are not necessarily good for households, are not necessarily good for housing affordability. They're not necessarily things that I think are great in our housing market. But I think there are things that might potentially avoid a disastrous crash in prices. And again, the ugly are the types of things that obviously could lead to bigger problems. So I think when we think about housing markets, I'm not a forecaster. I think for me, the key thing is to just try to look at the data and try to think about the different scenarios that might play out, and I think this is the only way we can make informed decisions. When I looked at the market and, people who were following me back then in 2016, 2017, the market was exploding. The narrative was this is a supply problem, prices are going to keep going up. But, when I looked at the data, I was able to see very quickly that, this was a market driven by investors. And it was not just investors, it was investors buying low-rise homes in the suburbs, very specific, right? And when the market turned, that was the segment that ended up being the most vulnerable. I think today it's a lot harder to do the type of analysis where you could, and this is what interests me most in a lot of the research I do, to understand the differences across neighborhoods and house types, because the factors that are impacting the market are bigger. We have, inflation higher, like there's just so many things going on. But again, I think this analysis is about trying to think about where we might or might not see problems in the future, because it helps us look at the data. So when we think about kind of the good, the first good in terms of stability is certainly the fact that the market looks stable right now. Like, even with high rates and 20-year low in sales, again, we're not seeing a surge in inventory. We're seeing prices plateau. Again, these are short-term dynamics, so they could obviously change. But certainly, it's not the dynamics that most people, including myself, would have expected. I would have expected inventory. If you told me in 6 months or 9 months ago that we're going to have 6 or 7 months of 20-year low in sales, what do you think is going to happen to inventory? I would think it'd be a lot higher than it is today, right? And it's not. And again, part of that is the fact that sellers aren't selling and are holding on to their homes. The other next good, of course, is one that we hear about a lot, and I think a lot of people don't appreciate sort of from a data perspective, is the fact that Canada's population has been growing a lot faster over the past 5-6 years, and we're not building any more homes, right? So I'll share a chart, which obviously people who are listening to this on audio are not going to be able to see, but I'll kind of describe what we're looking at. So over the past 30 years in our red chart here, that's our population growth. And Canada's population has been growing by on average about 320,000 people per year. And since around 2015, 2016, that has exploded to well over 500,000, right? And it dipped during COVID when we had our lockdown, but last quarter it was 700,000, so it's making up for those losses. So our population's growing by about 500,000 people per year. But when we look at our housing completions, which is in blue, we're not building any more homes than we were 15 plus years ago. We're building 200,000 homes. So, and this is kind of one of the challenges. I see some economists saying, well, I mean, during the bubble, I was not of the mindset that prices were rising 30-40%, in the last couple of years because of supply. Like, yes, we have a longer term supply problem, but it was a frenzy. I mean, there's very different dynamics. But when we think about the bigger issues, is certainly our population's growing faster than our ability to build homes. And even though a lot of the people moving to Canada can't afford to buy a home, they need a place to live at the end of the day, and they're going to rent. And this has been fueling the rental market, right? So certainly this cannot necessarily prevent prices from falling further, but it could set a floor to prices, because unlike some other markets, we're probably unlikely to be overbuilt, right? So I think that's an important dynamic. And the fact that a lot of people are moving to rentals makes the market attractive to investors. And this is, interestingly enough, the last sort of segment of sort of potential stability that we might see in the market. And this might be counterintuitive to anyone who studies housing markets or who's followed me or my reports in the past, because I've often said that, markets with a high share of investors tends to have the most vulnerable housing markets during these boom and bust cycles, right? And we saw that during the US financial crisis and the US bubble. The bubble states like California, Nevada, Arizona, and Florida that had the biggest share of investors, had the biggest spike in prices and the biggest decline. And Dubai's housing market, I did some work there, had a very similar dynamic. They had this big boom in investors and this massive bust. So the question is, well, why on the heck would I say that investors are a source of stability? And I think to answer that, we got to think about and try to define what we mean by investors, because I think it is actually quite relevant when we think about the financial profile of investors and the likelihood of them rushing to exit. So the first type of investor I want to try to quantify is what we call buy to sell investors, or flippers. People who bought a home and are selling it within 8 months. And if we look at statistics for that since 2006, it hasn't changed very much. It's been pretty stable, and in fact has been declining recently. And this is an important metric, because when we think about the markets that are the most vulnerable, the most volatile, it is the ones where there's a lot of flipping. Like, this is probably the worst type of investment behavior. I remember when I was doing some work in Dubai, they were basically saying that people were flipping contracts for condominiums every 6 months. like prices were rising that rapidly and people just wanted to make a quick buck. So this is a terrible, like if we had a lot of flippers, in our market, that would be a very, very troubling sign. The next type of investor are what we call buy to rent investors. And these people who bought a house and rented it within 12 months, right? And if we look back in the data, we see this rapid acceleration in 2016 and 2017 in buy to rent investors. And this really ties back to what I talked about earlier when I did that research on what was driving the boom in prices back then. It was largely people buying low-rise homes in the suburbs to rent them out, right? And again, that has declined since that period, and we're seeing a lot less of that, and it's certainly stabilized over the past couple of years. Now, it's this last group of investors that I think flies below the radar because they're not actively buying homes in today's market. And this last group of investors are people who have lived in a home, owned it for years, have decided to move out of the city, out of the province, or upsize or move to another home, but they've decided to keep their existing home as a rental property. And anyone who works in real estate, whether you're a broker, agent, or a mortgage broker, that for most people who own a home or a condo, their first question when they're planning to move is, can I keep my current home? And many people, when they upsize, will actually spend less in order to try to keep that existing property as a long-term income property. So these are people that I call previous owners. So they were owners. Once they've moved out and rented it, they've effectively become investors because that is a home that's been converted to a rental property. And when we look at the number of investors that are following that path, we can see that it has exploded. I mean, in 2006, just under 5,000, households were doing this a year, and over the past few years, it's just under 20,000, right? And this is the dominant type of investor in the market. So the question, of course, then becomes, well, why is that relevant? Why do we care that this is our dominant investor? Well, I think there's a couple of things going on when we think about this. The first is that these people didn't buy their homes at the peak of the market in 2022. And that's actually very important. That if you think about the people who are kind of most vulnerable, it's the ones who have bought at the peak, have the most debt, and have also seen their prices decline since then. But these people bought in 2010 or 2012 or whatever they bought. So they tend to have far more equity in their homes, right? Which I think is very important. The other important dynamic is that when we look at how this is impacting the market, these are homes that never make it onto the market for sale, right? This is inventory of homes that is just never makes it on the market for sale. The properties basically that would normally in a normal market have been listed for sale, but don't make the market. And what that means is that over time, there are actually fewer homes that are available to be bought by end users, right? Our stock of existing homes that can be bought by end users is declining because a lot of those, almost 20,000 a year are getting converted to rentals. So this is why if we look at the number of low-rise homes that have been rented on the MLS since 2006, it's exploded under about 3,000 or 4,000 homes per year in 2006 to 2007 to over 20,000 per year now. And this is basically telling us that there are now hundreds of thousands of low-rise homes, like family homes, that are now just investments that can't be bought. So what this means is that our home, and this is one of the reasons actually I should say our home ownership rate is declining because there are fewer homes that are available to be purchased by end users. More of them are being used as an investment. And this is kind of one of the dynamics I think that will actually provide some stability. Again, I don't think this is a good dynamic. I think, as I've said in the past, it's not great to have such a high share of homes owned by investors. But again, when you have this dynamic where our population's growing, we have more people looking to buy homes, and not only are we not building enough homes, but more of the homes are taken off the market, which means that there are fewer homes for buyers to actually purchase. This is, again, probably going to provide a little bit of stability or a bit of a floor to house prices. So I don't know if we want to kind of ask any questions about that, Ermi, before I kind of talk about the bad stuff.
I think there's some good ones about rent here. Let's go to, actually, I think there's a very interesting exchange that happened with your last section on short term. So first, let's go to the rent question. So again, Zaid says, it's crazy to think rental prices have gone up so much with so many investors putting up their units for rent. Shows how low overall supply actually is. I wonder when rental prices will peak and if there are any catalysts that will cause rents to actually fall.
Yeah, that's actually a very good question. So again, when we think about the dynamics that are pushing rents up, this is a byproduct of the fact that, you know, since 2015, 2016, our population's been growing far faster than the ability to build homes. At first, we saw this translate into rapidly rising home prices. But as home prices are cooling now and more buyers are getting out of the market, even with more, you know, the investors adding to the rental inventory, this is what politicians argue, is a misleading, it's not a solution to our housing market. What it's, even though, yes, they're adding to the rental inventory, they're creating rental demand because that home cannot be bought by an end user. So it's not a solution, right? All it's doing is pushing more people to the rental market. And I think in the short term, rents are going to get worse because what's going to happen is if home sales are going to stay low, which they probably will for a while as the market adjusts to high rates, people still need a place to live, like people who are moving or changing their lives. So if they're not going to buy, they're going to rent. So I don't think we're going to keep seeing rents surging 20% per year, but we're going to continue to probably see upward pressure on rents in the future as the housing market stays so high and unaffordable with today's interest rates.
And just to cap that off, Kevin makes a comment, which I think is interesting. People might not realize about the data. The Consumer Price Index, which measures inflation, actually includes for its shelter component rental prices. So interestingly enough, there is like a relationship between those higher rents and interest rate trajectories. That's just a comment. Now, there was a great exchange between Zaid and our colleague at Velocity, Davin, asking about buyers who are still active. How much are they being motivated by pre-approvals, which may locked in at particular interest rates, which may expire? Davin's comment was, you know, it's a little motivating if you're just compromising on one or two things, but you're not going to change, you know, what you're looking for your long-term fit for your family. So you're unlikely to rush.
Yeah, I agree 100% with Davin. I think, you know, the pre-approval motivation was bigger in the spring when rates were rising far more rapidly. You know, right now, if you got a pre-approval, like what is it? It's maybe in the high 4s and you might go to the, you know, 5.5% now. So, you know, it might motivate some people, but it's not going to push people to buy a home that they're not happy with. Like people are more inclined to wait because they think if I just wait, maybe prices will be lower. So I don't think there's an urgency due to rates. Personally, I haven't seen that or heard that very much.
I'm just going to finish with a comment from Hussein. Something I've always wondered, why doesn't the government heavily tax people who own multiple homes? I mean, specifically, I've always wondered why some left-leaning parties haven't tried this initiative as a campaign issue. What is the chances of that happening?
I mean, I think it's unlikely. I mean, our politicians are those investors. You know, our housing minister has low-rise investment properties. Pierre Poilievre from the Conservative Party has investment in single-family homes. I don't mean like buildings. I mean houses that could have been bought by families. So they're all investors. I don't, and they actually, when you look at their narratives, they see these as solutions to the housing crisis. Again, I don't, right? Like the dynamics I talked about earlier, I think are terrible. Like what's happening is the wealthy, if you want to call them that, and some of them are corporations, especially like in some of these outskirts, buying homes, taking them off the market, is just using them as a financial asset, right? And again, that's not supposed to happen. This is happening because investors are looking at the longer term dynamics, and they look at the fact that supply cannot increase very much. Doesn't matter what you do. I mean, I was at a conference, actually. It was funny. I was at a conference last week. I was speaking, and before the conference, they had this sort of intimate kind of dinner where some of the speakers and guests would speak. And one of the most successful people in the room and smartest guys in the room, I mean, basically came up and said, listen, all of these stories about governments doubling the completions of homes in 10 years, he basically said they should all be embarrassed because it's impossible. He said, even if they removed all the barriers, and he builds properties, he's like, there's no labor. Like, we just don't have the skilled trades to double the number of homes that we're building. So, you know, if you're an investor, you see that governments are set on this booming population growth story. And I think you just want to hold real estate. I mean, everyone, and then you look at the growth over the past 10, 15 years, every person says, I just want to buy homes. And I think this is not great. I mean, should they tax them? Possibly. They should limits, but I don't see that happening anytime soon, unfortunately.
The good is starting to sound like the bad. Before we move on.
Yeah, unfortunately. I'm not.
One last comment. And again, your point is that the good here, we mean price stability. So avoiding a huge meltdown in the market. Whether those high prices are good for the society and economy as a whole is another issue.
Yeah.
Final question about this relationship between home prices and rents. Alex asks, do we need to see home prices stabilize and people start buying again to see rents start stabilizing and moving down? Is there a connection?
Yeah. So, I mean, there is a connection between house prices and rents. I don't think it's the connection that most economists think. Like, most economists think once prices get too high, people rush and start renting. You know, it's kind of what's happening. I think it's the combination of high prices and high interest rates that make homes affordable. So, I mean, the short answer is yes. I think once you start seeing more people start buying homes again, you know, and that doesn't necessarily mean prices have to rise. I mean, it could just mean prices stabilize, but you know, the key is the sales volumes have to pick up. So if we see sales pick up for houses, then yeah, we should see some more stability in rents for sure. So should I kind of move on to our next section? So,
yeah.
All right, we'll talk a little bit about the bad, and the bad are certainly some of the bigger things, some of the things that we need to be mindful of when we're thinking about where prices might be over the next 12 months. Now, you know, we talked about prices as stabilized right now, and the market appears to be stable, but again, these are really short-term dynamics, and we don't know what's going to happen over the next 12 months. I mean, the first thing to keep in mind is that we're only 6 to 7 months into this rate hiking cycle, and we're going to see higher rates, so probably over the next 2 months. The market hasn't absorbed today's higher interest rates, right? And I think that's the most important thing that we need to be mindful of. Like, over the next year, you know, 20+% of households are going to be renewing their mortgages. And I would say virtually all of them are probably going to see a roughly 50% increase in their mortgage payments. You know, that's, you know, so if your mortgage payment was, you know, $3,000 a month now, when you go to renew next year or next month, it's probably going to be $4,500. Like, that's how significant the payment shock is going to be for a lot of people. And we don't know how that's going to impact. I mean, I personally don't think that's going to impact the average household as much. I think households will work with their bank to try to lower that payment, or they'll cut costs, or they'll do something. Like, most households do not just move out of their home because their mortgage went up. They'll usually cut other expenses. They'll not go on vacation, or they'll do whatever. So I don't think that's going to have the biggest impact on the vast majority of households, but certainly it will for highly leveraged households, like households that had a lot of debt going into this, that could barely get a mortgage when they bought their home, that bought recently, that are going with private lenders who have even higher rates than regular banks. You know, so certainly some people are going to get impacted. And I think the key thing to keep in mind is that even though I don't think, and I think most economists don't think we're going to see this flood of distressed selling, you don't need tens of thousands of distressed sellers. You just need like hundreds or a few thousand, you know, or hundreds in a small community that could distort the house price dynamics, right? So I think that's certainly one thing that we need to be keeping an eye on. We haven't seen very much of that, quite frankly, yet. But it could certainly be a story for next year, as a lot of, I mean, because we're already hearing it. I mean, I'm getting calls and meeting with people who are stressed financially already, right? and are thinking about, how do I keep this property, my home, and people with multiple properties, and they bought pre-con condos and trying to make it all work. So there's going to be some stress, and some people might have to deleverage and sell. So I think that's the first thing where we might, and that might leads to more inventory on the market, of course, right?
And John, can I jump in?
Yeah.
Sorry, continue.
So I was going to say, it's going to lead to more inventory, not necessarily more buyers. Like, that's a case where a distressed seller who has multiple properties needs to sell one to sort of get rid of some of their debt, could potentially lead to more listings.
So we have a question here from Zaid, and I think a lot of us have seen that CBC Marketplace report talking about potential issues in the private mortgage market, where agents and brokers have sort of promoted this idea of you can easily get money, commit mortgage fraud in some cases, declare incomes that are too high, and get into the market. Is there a possibility that kind of activity could be one of the flashpoints that you're talking about?
Yeah, possibly. And that wasn't even just in the private rental market. That was people who, that was fraudulent documents, even with big banks, right? So again, part of the story there was they were getting pushed to get pre-approvals that were above what they would qualify. Like, say I qualify for 800,000, but someone would create fraudulent documents and give me $1 million mortgage. Well, yeah, they're going to have a problem, because if in theory they can only afford 800,000 and now they have $1 million, like an extra 200,000 in debt. I mean, yeah, they're going to be financially stressed They were financially stressed households when rates were low because they were borrowing more than they qualify. They're going to have a lot of challenges again. But again, this also is a function of what type of mortgage if they have a 5-year mortgage locked in at 2%, they're going to be okay, because by the time they renew, who knows where the market's going to be. So I think it can impact. It doesn't necessarily going to impact all those people. But if you have a rate that's coming due soon and you have to renew, certainly those people are going to have challenges.
And the question is about private lenders. How much of the market is that? I think it's about 6%. Is that correct?
Yeah, I think I saw Ron Butler, who is active on Twitter. I think he said it's around 6%. And that's the pure private lenders, not any of the banks.
Okay, there's some great chat and discussion going on, even more around this issue. John, why don't you keep going ahead, and we'll see if we have time for more questions.
Yeah, and I see actually Davin from Rolosky actually posted a good comment. I'm just going to touch on before I go on, that some people who have private mortgages are not even getting renewals, right? Which means if their mortgage is coming up, the bank is saying, give us our money or get a mortgage with someone else. That could be another source of distressed selling effectively, right? And private lenders are doing that because, most private lenders are not in the business of banks just renewing your mortgage every year. They're meant to be a short-term vehicle for people to go to another lender. But if that's not an option, especially if someone who bought at the peak, their home's worth less, rates are higher, they may be forced to sell. So Davin actually made a great point that is another segment of the market. If you think about that's 5 to 6% that have private deals, well, that's a good portion of those may have a hard time renewing or may not even get renewals. The other bad thing that we got to keep in mind, of course, is that, Canada economically and a lot of other countries, most people are calling for a recession. And in fact, Bank of Canada Governor Tiff Macklem effectively said, and a lot of economists in the US is that they actually needs to push up the unemployment rate. They needs to take pressure off of wages to cool inflation. I mean, it's just a bizarre world we live in when this is the solution, like to drive people out of work. But this is technically what they're trying to do, to cool the market so rapidly that, some people get unemployed, jobs are lost. This takes pressure off of the labor market. Wages are not rising too rapidly, which is kind of keeping inflation lower. But of course, this is going to, of course, impact sort of not just the demand for housing, it's going to impact the sentiment of the market. And I think this is the harder part we got to think about. If people start losing jobs in different industries and, housing, construction, whatever it is, you're not only you could potentially see even fewer sales than we're seeing today, right? Like today we have 20-year low in sales and our economy is quite stable. If things do get worse, you could see demand pull back even further, right? And again, it's the sentiment. If it turns pessimistic and people start worrying, this is where it's very hard to predict these trends, and they have the biggest impact short term. If we think about the fall market, I would say the big impact was it was a complete shift in sentiment. Buyers went from being FOMO, I need to buy right away in January and early February, to wait a second, there are more homes. You know what? There's only 1 or 2 offers. Okay, I'm going to wait. I'm not in a rush. You know, maybe prices will dip, right? And buyers started getting pessimistic and sellers started getting pessimistic. So those dynamics could in fact impact the housing market. And again, they're impossible to predict, right? And I think obviously the banks are trying to mitigate a deep recession, but certainly I think a recession and the impact on labor markets is something that we're going to have to keep an eye on over the next 6 to 12 months. Any questions before we wrap up on?
I think you can keep going. There's some good comments around, you know, are we already in the recession? And, you know, a lot of different indexes and stats being shared around that. So
yeah, we're going in that direction. I think it's, you know, again, I think it'll be important to see to what extent do we see job losses and in what sectors, and obviously all of that's going to matter. But I'm just going to wrap up with, you know, the ugly scenario, this kind of the bigger systemic potential problem. And it's one thing that we've been hearing about and seeing already. I mean, I was quoted in this article from the Financial Post that talked about how pre-construction condo flippers may be holding the bag as buyers disappear. So really what this is about, and I'll kind of try to unpack the dynamics that we're seeing. When a lot of people buy pre-construction condos, some of them, I mean, the ones who bought 4 or 5 years ago who have a condo that's coming up for completion now, there are a few things coming up. So one, some of those buyers just can't afford to get a mortgage now based on today's much higher interest rate, right? And some of them could never afford it to begin with. They just bought it with the intention of flipping it before completion, so they would never have to get a mortgage. So when you flip a pre-construction condo, it's called an assignment sale because that investor technically doesn't own the unit yet. They're trying to assign their contract. So assignments are exploding right now. They cannot be listed on the MLS. That's why we have very little data on them. They're listed on private message groups and Facebook groups and WhatsApp groups because builders don't allow investors to advertise them. So there's not, I mean, even though many of those investors will have distressed in their ad headline, they're not really distressed. Most of the people who are selling pre-construction today have made money because they probably bought in 2018 or 20, so whenever they bought, and you know, they've seen an increase in the value, right? But if rates stay high, if we see more pressure on condo prices over the next, say, 24 months, you know, this is where the longer this stays like this, the more likely it is that these investors not only have a hard time getting a mortgage, but by the time their condo's finished, it's not worth what they paid for it, right? And when we look at what has happened in other housing markets during the bubble, I mean, ones that had a huge segment of demand from pre-construction investors, like, you know, Dubai and Florida and Las Vegas, whatever, they had the same problem. And what happened was investors just walked away from their purchase because, and in some cases, stopped making their deposits because the condo was no longer worth what they paid for it. So they just said, forget it, I'm out of here. Now, I mean, I'm not going to say that this is going to happen. These are, again, the potential scenarios. These are, you know, so again, it's going to depend on sort of the future path of interest rates and prices and all of that. But if that does happen, the one positive spin to that, I think that makes us less vulnerable than those other markets, is that those other markets were significantly overbuilt. Like they built so many homes, largely just because there was so much demand from investors, but there wasn't as much demand from end users when they're actually built. So those markets actually saw an oversupply of homes once those units were done, or those houses were done, which depressed prices for quite a while. And I think that's the one thing that's different here. So I think this could impact pre-construction condo investors. I don't know to what extent it would impact the rest of the market. And again, I think because we're not overbuilt, and my instinct is, if there is distress from pre-con investors, I mean, there's going to be corporate investors willing to take advantage and go in and buy those units. I don't think they're just going to be sitting empty for years because we have an oversupplied market. So it's, you know, it's a certain area of distress we need to keep an eye on, but I don't think it's going to be as bad as some of those other countries that saw similar dynamics in their pre-construction condo markets that were also driven by investors. So I think that's kind of everything for this month. I don't know if we had any other questions, Ermi.
We had a lot of great questions. In the interest of keeping this to a reasonable hour for everyone to take in on their lunch, we're not going to be able to get to all of your questions, but we will keep them in mind for a future session next month, or you know, as the data kind of leads us more into some of these issues. I think I wanted to end with a really, I guess, something that a lot of people are thinking about right now, and you mentioned it in your report, John, about whether bank or other policy actions are possible if people have trouble renewing their meeting their mortgage payments. And Recoil asks, can't they just extend their amortization if they are desperate? So, yeah, you know, you touched on you would need a policy change for that, and how likely would that be?
So that's a good question. So most of the bankers that I've been speaking with over the past month, this is what they're seeing. So just to unpack this, the question and the concern is, well, you know, as I talked about earlier, if you're renewing your mortgage today, and your mortgage payment was $3,000 and you at today's rate, it's gonna be $4,500. That's a massive payment shock, right? So what a lot of banks, I think, are going to start doing, and what they've already started talking about doing, and what might be in the pipelines, is to not just allow that homeowner to extend the amortization. So think about it this way: when you get a mortgage, let's just say you have a 25-year mortgage. Well, in theory, when I renew now, you know, I should get a 20-year mortgage to kind of keep that schedule so I'm paid off in 25 years. Well, rather than doing that, the banks might say, okay, we're going to allow you to extend that to 30, or maybe even 35 or 40. So one of the things that banking regulators might allow is to allow even longer amortizations. Today, it's just 30, but to potentially allow longer ones for renewals, not for new purchases, right? And the idea with that is that it would soften the payment shock for those households, because banks don't want to take over people's homes. They don't want them out of their homes. They don't want to see prices fall. They want stability in housing markets. But beyond that, the fact is, like I said, if your payment goes up 50%, this has a wider domino effect on the entire economy, because if a household's expenses go up an extra $1,500 a month, that realistically is $1,500 a month less that they're spending anywhere else. So this can fuel a deeper recession, which again, policymakers want to avoid. So this is partly why I said earlier, my instinct is most households are going to manage, and partly through banks that might be more accommodating. Now, interestingly enough, someone had just messaged me today, or I think it was this morning, who said that, you know, they have a variable rate mortgage with Scotia. They tried to, you know, extend their amortization to lower the payment shock, and basically Scotia said no, which was unbelievably surprising to me. But my instinct is, as we go further along and these rates are impacting households more, I think banks are going to be more flexible with their renewals and allowing longer amortizations to, I think, soften the payment shock. But again, keep in mind, I'm not suggesting that this is going to happen for new purchases. I think the rules for new mortgages will probably stay very similar. This is strictly for people renewing mortgages that banks might be more flexible to ease the increase in payments.
All right. Well, we continue to have a great discussion, great comments. John, if people want to rewatch this event after it's over, will they return to the same link here?
Yeah, it'll be up on our YouTube channel for sure, that people can watch it after.
Okay, and we'll also have a share function there. So I believe John will make this public so you can share it with others. Please come back to ask your questions live. That's the more dynamic part of the session. And you can share this with anyone else and ask them to join our list. If you have any questions, just reach us at movesmartly@relosby.com. And thank you again, John, and thanks to everyone for your great questions and for joining.
Thank you, everyone.